One group of stocks is booming after the election, with some up 7 and 10% or more in a single day. In fact, this group just had its 10th best single day return, going all the way back to 1998 and on 4 times the normal volume. In this video, I'll reveal that hot stock sector, why it's surging, and show you the 5 best stocks to buy right now. We're talking top stocks today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I am excited to bring you today's video, a group of stocks that have broken out since the election and I think could go a lot further from here. In fact, this could be the breakout sector of 2021. One of these stocks I'm even putting into our 2021 Bowtie Nation portfolio on StockCart. We're just 2 weeks into the portfolio, already up 4% in that time and outperforming the S&P 500 by almost 5%. I'm going to wait till next month to do an update video on the portfolio because I want to get to those 5 stocks I'm watching. I'll leave a link in the video description below. Click through and follow the portfolio on StockCart. It's totally free to follow and you'll get trade alerts anytime I buy or sell from the portfolio immediately, even before these videos come out. And as a special bonus, I've negotiated an exclusive discount for everyone here in the community. Use the promo code BowtieNation, all one word in lowercase, and you'll get a special discount beyond the 2-week free trial. Nation, healthcare stocks have been one of the biggest underperformers of the year. You can see in this table of stock returns by sector, healthcare is up just 3% in 2020. And the prices on stocks in this sector have gone nowhere. A chart here all you in the Bowtie Nation are going to recognize. The dark blue line here is the current price to earnings ratio on a forward basis for each sector. The green then is the 10-year average, and the percentages are how much above that long-term average that you're paying for these stocks. How much more expensive the stocks are in that sector. And that underperformance in healthcare stocks this year has made it the cheapest in the market, trading just 9% over that long-run PE average. And it's really been just a few forces that are weighing on that sector. First, you've got the uncertainty around the ACA, the Affordable Care Act. If the healthcare program gets shut down, then we could see demand for services, healthcare services, fall by anywhere from 15 to 25 million people. You've also had fears around that drug pricing regulation and other regulatory risks. And finally, with the pandemic, a lot of those higher margin services were postponed or even canceled. But this group just had a massive move last week. After the election, the sector was up 5.5% on Wednesday alone. It's the 10th largest single day move in 30 years. And Nation, it's because even though those results aren't definitive yet, investors are looking at a split control in Washington and just seeing those dark clouds clear up. And if you look at the top stocks for the day, you see where the strength is. Drug makers were 6 of the top 12 best stocks, and health plan providers 3 of the top 5 performers. With that split in government or just very narrow control, we're less likely to see those big regulatory changes in the healthcare space. It's a huge sigh of relief, and this recent move could just be the beginning. Even after that move last week, the SPDR S&P Pharmaceuticals ETF, ticker XPH, is up only 4% on the year and trades for a price of just 10.8 times expected earnings. That's nearly half the 22.7 times multiple we see in the overall stock market. The iShares Healthcare Providers ETF, ticker IHF, is a little more expensive here, trading at 16 times on that forward PE ratio, but still cheap here, and these are some great dividend stocks that we're going to talk about today. Now, those 2 funds will probably do well as those drug makers and the service providers benefit, but the best returns are always going to be finding the top stocks in the space, the 5 best for your money. First here, United Health Group, ticker UNH, is the largest private health insurer in the United States, as well as having a strong business line internationally. Shares were up over 10% on Wednesday alone and pay a 1.6% dividend. United Health insures over 50 million members, covering 15% of the insured population. That puts it well above the next largest rival with just 10% of the market. Combine this scale with a strong health information technology business and a pharmacy benefits manager to negotiate those costs, you've got a business model that just can't be beat. In fact, the CVS-Aetna deal and the Cigna Express Script mergers over the last several years, those were both in just the attempt to copy that United Health business model. And now on these types of regulatory risk stocks like we'll talk about today, I always look at these management effectiveness ratios like the return on assets, that's the ROA, and the return on invested capital, the ROIC. Comparing these ratios across stocks is going to show you which management teams are able to really produce, able to use those assets and the capital to drive a return, even with that regulatory burden. But when you can find one of these well-run companies and the government gets out of the way, they can really start to fly. So here we see the ROIC for United Health is about 15.5% over the past year and a return on assets of 9%, which are both slightly above the industry average, which is a great sign that I'm looking for. Anthem, ticker ANTM, is a smaller health insurer but still one of the largest with over 42 million members in 23 states, and it's the largest single provider for Blue Cross Blue Shield coverage. So I do like United Health, but here's why I like Anthem just a little bit more and why I'm putting it into our 2021 stock portfolio. Now, Anthem is in just 23 states versus United Health's national coverage, but at 42 million members, it's a close second to that 49 million people covered by UNH. And it's because in the states where it operates, Anthem has a much deeper market share, upwards of a third of the market. Now, it's got an exclusive license with Blue Cross in 14 states, which is arguably the most trusted franchise in health insurance. This all works to give Anthem a lot more negotiating power with providers, helping to lower costs, pass some of that savings on to customers, and then keep some of it for higher margins. Revenue grew at a 7% annual pace over the last 3 years, which the company was able to then turn into a 20% annualized earnings growth. Shares trade for a price of 15 times earnings, about a 17% discount from where it traded just last year. I added shares of Anthem to our 2021 portfolio last week. And again, look for that link below and follow the portfolio on StockCard to get those notifications when I buy or sell anything before the videos come out. In the drug makers now, and a favorite of mine here, AbbVie Incorporated, ticker ABBV, and its 5.9% dividend yield. And Nation, besides the upside potential on these stocks, I love the idea of investing in healthcare companies just as a way to hedge my own costs in retirement. Now, if you look at it, even with Medicare, the average retiree pays up to a third of their drug costs out of pocket, and it can be as much as 15 or 20% of your total expenses. So what better way to hedge these costs than by benefiting from the shares of those drug makers, those healthcare providers? AbbVie completed its acquisition of Allergan in May, which significantly increased the product portfolio for leadership in oncology, immunology, and eye care. In fact, 2 of its oncology drugs are growing into blockbuster status, and one of which, Venclexta, is growing sales by more than 100% annual rate, did $317 million in the last quarter alone. Management here is producing almost a 12% return on invested capital and a 7.6% ROA. Both are a little below the benchmark here, but I think those recent cost cuts can boost these. Earnings are expected to jump 16% over the next year, and analysts have an average target of about 12% above the current price, and that's beyond that 6% dividend yield. This next drug maker I've owned for about a year, and it's just starting to turn around. Shares of Teva Pharmaceuticals, ticker TEVA. Teva got into trouble there for a while. It had an aggressive acquisition strategy that put a lot of debt on the balance sheet, and then those opioid lawsuits just hit it and just wiped it out. Still though, 1 in 10 prescriptions in the United States is filled by Teva. It's the largest generic drug maker in the world. A forward-thinking restructuring plan has cut $3 billion in annual costs, and the company has sold off a lot of its unprofitable drugs. Revenue on generic sales has stabilized, and the lawsuits look like they're all settled or close to settlement. Now, this one was on its way back up, hitting $13.20 a share in February before the pandemic, and analysts have an average target of $12.25 each over the next year. That alone would be a 33% increase, and I think it can go even further if you look 3 or 5 years out. Gilead Sciences, ticker GILD, has benefited from its remdesivir treatment for the virus, but I like the drug maker better for its pipeline and 4.6% dividend yield. Gilead is a leader for drugs treating HIV and hepatitis, 2 of the highest profit margin markets in pharmaceuticals. In fact, Gilead is so successful in HIV treatments that it serves 80% of the patients in the United States. Now, the company is just an R&D machine with 38 candidates in its pipeline. That's 10 in viral diseases, 15 candidates in inflammatory diseases, 3 of which are in phase 3 trials for 6 uses, and 13 candidates in that oncology pipeline. Again, some with multiple indications that could go blockbuster. Shares here trade for just 9.7 times earnings, making it the cheapest stock in the list, and those earnings are expected 5% higher over the next year. I think you can bank a solid double-digit return plus that dividend yield on this one and hold it for the long term. Look for that link in the description and follow our 2021 portfolio on StockCard. Click on the video to the right for the first 5 stocks to buy in our portfolio, and don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.